Late payments don't just slow down your bank account, they put pressure on payroll. That's the part a lot of installation contractors don't connect fast enough. The job gets finished, the invoice gets sent, the customer says they'll pay soon, but your crew still needs to be paid on time. Materials still need to be covered. Fuel, insurance, trucks, and overhead still keep moving. So now the business is stuck in the middle. The work is done, the money is not in, and payroll is coming whether the customer pays or not. That is where cash flow gets tight fast. I'm Josh Savage, founder of Savage Financials. I help installation contractors understand where cash is getting stuck, where profit is leaking, and why payroll can feel stressful even when the business is busy. One of the biggest pressure points I see is late payments. Not because the contractor has no work, not because the crew is sitting around, but because completed jobs are not turning into collected cash fast enough. And when that happens, the owner ends up covering the gap. That gap creates stress. That gap creates guessing. That gap makes payroll feel way too close for comfort. I was going through cash flow with a contractor recently, and he had one of those weeks where, looking at the business from the outside, everything looked fine. The crews were busy, the jobs were getting finished, they had work scheduled out, and the jobs themselves were profitable. But on a Wednesday afternoon, we were looking at the next few days, Friday payroll was going to be tight. Not because there was no money coming in, there was plenty of money coming in. The problem was when. He had a little over $60,000 sitting in accounts receivable. And this wasn't some situation where nobody knew who owed what. They had it tracked. Some of it was sitting in QuickBooks. Some of the job detail was being managed in spreadsheets. They could pull up the balances. They could see the invoices. The problem wasn't really a process around what happened next. There wasn't a set time every week where somebody sat down and reviewed what's unpaid. How old is it? Who has been contacted? Who said they were paying? Who's starting to drift, which invoices are becoming a cash problem. Information existed. Nobody's really managing it. And when we laid everything out, there was one customer in particular that had become a problem. They had several completed jobs sitting unpaid. One invoice was a little over $11,000. Another was around $14,000. Another was just under $9,000. So there was more than $30,000 sitting with one customer. The work was done. As far as the contractor knew, there wasn't a dispute. Nobody had called saying the work was complete. Nobody had questioned the invoices. They just hadn't paid. Meanwhile, payroll was still coming Friday. Materials had already been bought, fuel had already been burned, the crew had already done the work, and the business had already spent most of the cash required to produce those jobs. The contractor did collect deposits up front. That was actually one of the first things I looked at. They weren't starting every job with zero cash, but the deposits weren't large enough to meaningfully protect them. They helped, they just didn't help enough. So the company was carrying too much of the job financially between the time work started and the time the final payment actually came in. And you could see it clearly that week. The jobs were profitable. The receivables were there. The cash sitting in the bank and the cash coming out for payroll were getting way too close together. And the contractor told me he could just move money over from his personal account. He had enough available to cover the difference. Get through payroll Friday, wait for the outstanding invoices to come in, and then put the money back. And technically, yes, that would solve the immediate problem. But I didn't want that to become the solution, because once an owner gets comfortable doing that, it becomes really easy to keep doing that. Payroll gets tight, move personal money over, customer pays, put it back, 2 weeks later, do it again. And at that point, you haven't solved the cash flow problem. You just turned the owner's personal bank account into the company's line of credit. So before we moved anything over, we went through the receivables one by one, not just looking at the total balance. We wanted to know the actual status of all the invoices. When was it invoiced? When was it due? Has anyone followed up? Is there an issue with the work? Was there an issue with the invoice? Has it been approved on the other end by the company? Is it actually scheduled for payment? And then they contacted the customer with the 3 large outstanding invoices. Not aggressively, there's no reason for that. We just wanted to know exactly where the money was. They went through the invoices with them and verified there weren't any problems with the work. There weren't any disputes with the amounts either. The invoice has actually already been approved internally. They're basically just sitting in the customer's payment process. And because they actually got on top of it and had the conversation, they were able to get portions of those approved balances pushed through. That gave the contractor the cash they needed to get through payroll without having to cover the whole gap personally. So we solved Friday. But to me, that was only half of the problem, because I didn't want to have the exact same conversation a month later, 6 months later, a year later. The company already knew what it was owed. We didn't need to invent some complicated tracking system. What was missing was a process for actually managing what they were owed, and the payment structure itself wasn't doing enough to protect them. So we started with the deposits. They are already collecting money up front. We increased the percentage. The idea is simple: get more cash into the business before the contractor starts committing labor and buying material. That way, with the final payment stretches, the company isn't carrying as much of the job with its own cash. Then we changed how the final pricing and payment terms worked. We slightly increased the stated price of the project up front. Then we offered a discount that brought it back down to what the contractor actually wanted to charge if the customer paid within the preferred payment window. So if the customer paid within that window, their price hadn't really changed. They got the discount. They paid what the contractor had intended to charge in the first place. But now there's actually a reason to pay earlier. And on the other side, we added language that if the balance went past a certain date, fees would start accruing. So now the payment structure was doing 3 different things: get more money up front, give the customer an incentive to pay earlier without actually changing the intended price of the job, and create a consequence if they pay late. Then we set up the other piece that had been missing: a weekly accounts receivable review. Nothing complicated. Once a week, pull up the unpaid invoices, sort through what's outstanding, look at what's coming due, look at what's already late, check the notes from the last contact, identify anything that's starting to drift, and follow up on the handful that actually need attention. Once it's set up, it takes around 15-30 minutes a week. But now if $30,000 starts stacking up with one customer, they don't discover the problem because payroll is due 2 days away. They see it happening. They can call while the first invoice is getting slow instead of waiting until 3 invoices are sitting there. They can verify whether something is actually approved. They can find out whether there's a problem. They can get a real payment date. And if necessary, they can start changing what they're willing to fund for that customer before the cash problem gets bigger. That was really the entire change. We solved the immediate payroll problem by getting on the phone, verifying the invoices were good, and getting approved payments pushed through. Then we changed the system so the owner wasn't relying on his personal account every time collections got behind. Because the goal wasn't just to make Friday's payroll, the goal was to stop Friday's payroll from becoming an emergency in the first place. This is the distinction I think matters. Tracking accounts receivable and managing accounts receivable are not the same thing. Most seasoned contractors already know who owes them money. They have QuickBooks, they have accounting software, they have a spreadsheet. Somewhere, the invoices exist. That isn't usually the problem. The problem is whether there's a repeatable process for reviewing those invoices and doing something when the payment starts drifting. Because an accounts receivable report sitting in QuickBooks does nothing for cash flow by itself. You have to actually use it. And that contractor is a perfect example. The money wasn't lost. The customer wasn't refusing to pay. The work wasn't being disputed. The invoices had actually been approved. But until somebody picked up the phone and verified all of that and pushed the issue, the cash was still sitting in someone else's account while payroll was coming out of his. That's why the weekly reviews matter. Once a week, spend 15 minutes looking at it. What's unpaid? What's due this week? What's already late? Which customers are consistently slow? Who needs a follow-up? What did they say last time? Has the invoice actually been approved? When is it scheduled to be paid? And is anything large enough that it could create pressure on payroll or material purchases if it slips another week? That's basic accounts receivable management. But doing it consistently changes the business because now you're seeing cash problems before they arrive. The second piece is your payment structure. If you already take deposits, that's good. But the real question is the deposit large enough to actually protect you? If you're collecting a small amount upfront, but you're about to spend significantly more than that on labor and material before the next payment comes in, you're still financing most of that project. So we increased the upfront percentage. That lowers the amount of the contractor's own working capital exposed from the beginning. Then we worked on behavior because customers respond to incentives. Instead of just saying, please pay us faster, we gave them a reason to. The project price was set slightly higher up front. Then if they paid within the preferred time frame, they received a discount that brought the price back down to the contractor's intended price. So the customer who pays within that window isn't really paying more. They're paying what the job was supposed to cost. The customer who waits longer gives up the discount. Then, once the payment goes beyond the agreed late date, fees begin to accrue. So there are really 3 layers to the structure. More upfront protects you before you spend the money. The discount encourages the customer to get the remaining cash to you faster. And the late fee makes it expensive to use your business as free financing. Then the weekly accounts receivable review sits over the top of all of it, because none of these terms matter if nobody is watching you. And I like attacking the problem from all of those directions because you're not relying on one thing that fits cash flow. You're reducing how much cash you have exposed. You're incentivizing the behavior you want. You're penalizing the behavior that hurts the business. And you're creating a process that catches problems early. That's also why I push back on using personal money as the solution. There's nothing inherently catastrophic about an owner putting money into their business. There are situations where that completes sense. My issue wasn't the pattern it could create. Every time payroll gets tight, the answer is, I'll move some personal money over and replace it when customers pay. Then the owner absorbs the consequences of a bad collections process, and the business never has to fix it. I'd rather see that $30,000 building up 2 weeks earlier. I'd rather call the customer then. I'd rather find out the invoices are approved and ask when they're being released. I'd rather know the customer is starting to stretch payments before I continue putting more labor and material into their next 3 jobs. That's what visibility gives you. And none of this requires some sophisticated finance department. Once a process is built, we're talking 15-30 minutes a week. Hold the accounts receivable, review it, follow up where necessary. Update what you realistically expect to collect. Then compare that against what's coming out. Payroll, materials, insurance, trucks, everything else. Now payroll isn't surprising me. If there's going to be a gap, you can see it coming. And that's really what better cash flow management should do. It shouldn't just tell you why you ran short. It should give you enough visibility to see the pressure coming and enough structure to keep it from happening as often. The dangerous part about late payment is that they feel normal. Customers pay late, builders drag their feet. Homeowners forget, invoices sit, but just because it is common does not mean it's harmless. Every unpaid invoice is cash your business already earned but cannot use yet. And if that cash is needed for payroll, materials, or the next job, the whole business starts operating under pressure. That is why payment terms, invoice timing, and follow-ups are not small admin tasks. They're cash flow protection. In the next video, I'll talk about how extra work can become paid work when the change order process is clear. And if you want help seeing where late payments, loose terms, or cash flow gaps are creating pressure in your installation business, book a call here at savagefinancials.com.